All right, what's going on, everybody? Nolan Sambrun here, your partner and mentor with the CRE Collective. What we're talking about today is a couple of different ways how you can finance and purchase real estate. In the past, I was from Kokomo, Indiana. I read all the books, was on Bigger Pockets, dancing around the forums, trying to find a way to become financially free. That was like the idea I was chasing. Have more passive income than monthly expenses. Then I can go drink Mai Tais on the beach. That's what I was chasing. Well, very simply, I discovered that real estate really isn't as passive as what I thought it was, and it's actually a lot more work. So if I'm going to spend my time in real estate, how do I want to be doing it? What do I want to be doing, small deals or big deals? So out of the time, I was buying these rinky-dink $50,000 houses in Indiana. I got up to about 55 houses at one point before I read the book Commercial Real Estate Investing by Dolph DeRoos. If you haven't read that one, I recommend that as well. And then that's what switched the gear for me and flipped the gear. I've since sold all 55 houses. I now own just under 245,000 square feet, 14 industrial warehouses in the southeast of the United States. And so we're just trying to buy more. We need more partners to join our group so we can purchase property all over the United States. But today what we're talking about is the 3 different ways how you can finance or purchase commercial property in this case. Very quickly, though, I'll give you a quick undertone on how you can underwrite real estate. I'll give you an example when I was buying these houses in Kokomo, Indiana. So before, the 3 main ways that you can do this is by you as the individual injecting the equity, right? You can talk about all cash, or if you're using a bank and things like that, that's one way. I'm always going to be borrowing money, so that's what I'm going to be focused on today. So let's give an example of if I'm buying a $100,000 single family house. I'll call this a purchase price of $100,000, okay? Usually, now you can get cute with some terms on the debt, but let's talk about putting 20% down, which is roughly $20,000, right? And that's gonna be, again, an estimate. Sometimes it's a little more, sometimes it's a little less. You're gonna get a loan for $80,000, right? Oops, 80,000, there we go. And then the rent on this property, because it's a single family home, is going to be what's called a gross lease. That means that the tenant is going to pay you a certain amount of money, and then you, the landlord, are responsible for all the outgoings. You pay the property taxes, you pay the insurance, you maintain the property, you cut the grass, you do all the work. If the toilet leaks, he's calling you, right? It's not right or wrong, it's just that's one way of doing it. So let's say, though, that the gross income is on a $100,000 property. I like to use a 10% cap rate. So call it $1,000 a month of rental income, or probably $1,500 and you net out that. But let's say gross income is $15,000 a year. And then your expenses are $5,000 a year. And then you are left with a net operating income of $10,000. And then you have your debt service, which is ballpark probably going to be about $7,000. So you're left with cash flow of about $3,000 a year, right? So on a $20,000 investment, roughly, what is that number? $3,000 divided by 20, 15% return, all right? So ROI is 15%. That's actually not even really that bad of a deal in my book. It doesn't matter really what you're looking for. You see cap rates on social media that are trading in like the 6s. Buying a Chick-fil-A, you have to buy those at like a 5 cap. So being able to buy something at a 15% rate of return is actually not that bad of a deal. But here's the problem with single family homes. This is just one way of underwriting this. Just let me recap those just so you can see how you got there. $100,000 purchase price, down payment of $20,000, $80,000 loan. You're bringing in $15,000 a year. You got some expenses. You're left with, again, $10,000. You pay the bank their principal and interest, and you're left with $3,000 of net cash flow that you put in your pocket every year. I really won't get into depreciation all that much today, but that's a huge tax benefit that you can read in Tax-Free Wealth by Tom Wheelwright, who's Robert Kiyosaki's accountant. That, to me, that book is another one of my 5 Bibles that I live and die by. If you haven't read it, please purchase it. It will just change how you think about money and taxes and everything like that. But again, this is just one way of doing it. That's what I was doing. I was buying these houses, these smaller deals, injecting money, $20,000, But eventually what you'll discover is if you're Elon Musk or Jeff Bezos or a peon like myself, eventually you run out of money, eventually. So what I discovered is when I bought one of my first commercial properties in Tarrant, Alabama, which is northeast Birmingham, I was buying this building for $1.35 million. This is my first commercial deal. This is another way to do it. So that was the first way of doing it, injecting a down payment. The second way is by the seller leaving money in the deal. So I'll tell you the story again. I'm trying to figure out how to buy this $1.35 million deal. I'm borrowing $1 million. My parents thought I was crazy because I was a Dave Ramsey guy, buy term, invest the difference. Debt is bad, cash is king, that kind of thing. So I didn't have the mortgage, I didn't have the bank to lend me $1 million, and I definitely didn't have the $350,000 down payment in order to inject into this deal. I had no clue how I was going to close this deal. Eventually what I did though is I called the bank that held the mortgage on the property before, and I asked them if they were curious to continue holding the paper. Absolutely. The tenant that I was buying the building on that was in there had been there for like 16 years. There was 7 years left on this lease, and basically, the tenant was pretty strong. They had a really strong balance sheet. So the bank was like, look, we're very comfortable with this tenant. Me as the borrower, they weren't even really concerned with me because in commercial real estate, the value of debt is not the borrower. It's actually the strength of the tenant, the lease, and how long they've been there. That's really the most important difference between residential and commercial is when you're borrowing money with residential, it's you, the borrower, that's really the strength of the debt. You're the one that's on the hook. In commercial real estate, yes, you're borrowing the money, but you're really just the conduit to the bank to earn interest. And you're the one as the owner getting all the tax benefits. But so how did I buy this building? Again, where I didn't have $1.35 million. I went to that bank. So if you haven't done this yet, next time you're buying a property, figure out who holds the note on the property already. That's going to be a 90% chance for you to actually get a mortgage on that property because they're already familiar with the asset. But then second, what I did then is instead of me having to come up with $350,000, the seller actually offered me to leave money in the deal, meaning that he finances me the down payment or the $350,000 that I would have had to show up with at closing. Instead, he left that money in the deal. The same way that the bank financed $1 million, this guy financed me $350,000. So instead of me getting one mortgage for 75%, instead I got 2 mortgages for 100% of the purchase price. So you might be thinking the same thing I did. I thought I was getting bamboozled by this cat. I mean, talked to my accountant. I was like, this is a little funky. Basically, it's a way that the seller can separate his capital gains into 2 separate years, and then it can reduce their tax exposure if and when I balloon him out in the future. So let me walk you through what this looks like again. So this is a purchase price of $1.35 million. Again, it was cool because it was my first deal. I mean, it's first 7-figure deal. And I've discovered that really that's probably 80% of it. At the end of the day, is all about how you think. Once you think big and once you get past that glass ceiling of doing a 7-figure dollar deal, candidly, the smaller deals just become boring. They become kind of like, it's not even something that you want to go for. You start to think bigger and bigger, and that's really where it gets fun, when all the deals start having 8 figures and things and beyond. But $1.35 million down payment was going to be $350,000, $350K. My loan was $1 million. I mean, call it in some change, So my debt service, I believe, every month was going to be, or every year was, I think it was like 65 grand or something, $65,000, and that was to the first mortgage. The second mortgage debt was going to be like $16,000 or $15,000, call it that. So total was $80,000 of debt service. But then my net operating income, though, was $125,000 of net operating income. And the difference here, again, like I mentioned before, is with this lease, it's not a gross lease where the tenant is paying me a number and I'm paying the expenses out of it. Instead, they actually pay the taxes, the insurance, and they maintain the building. I'm not responsible or on the hook for that. So that's kind of cool. So basically, when they pay me $125,000, I net $125,000. I don't have to pay any other expenses. So my cash flow was $45,000 a year, and I was in this deal for no money, which is kind of cool. And so again, what's amazing about this is, again, there's a lot more tax benefits with this, like bonus depreciation that you can take to offset other income and things like that. But essentially, I took this $45,000 and that went into my pocket. I didn't have to really expose myself to anything because, again, I was showing up with 100% debt. And again, the way that would look on your HUD statement is you'll see, all right, we need to definitely buy some more markers. On our HUD statement, a first mortgage of $1 million and then a second mortgage of $350. To total that total purchase price, those are the total credits. Is that one? I think that one's busted up too. Yeah. So what I'm getting at is, regardless of what the cash flow is, again, because the hill and the metric that I'm willing to die on is cash on cash return. That's the hill I'm willing to die on. And the less money that you have to personally inject in the deal, the higher the cash on cash return goes. Like I showed you a minute ago, the 15% return on the single family home is not bad, right? That's a pretty good rate of return. But what happens when you're making on this deal, you're making $45,000 of cash flow? How do you find what your cash on cash return is? You just divide what you put in it by how much, or what you're making by how much you put in it. So if you're making $45,000 a year and you divide that by 0, which is what I had in it, my return is infinite. And therefore, I can do an unlimited amount of deals, okay? And so that's the second route that I discovered. And that's how essentially I've been able to buy 11 of the 14 commercial properties that I own now. It's by me not having to show up at closing with any of my own money. I'm negotiating and showing the seller how he can save money in taxes, and most importantly, create a new stream of income, because most of these guys are owner users and they don't think about the fact that, yeah, they might have a war chest now, but now it's a race against time because they don't have any new money coming in. So this is an opportunity for them to earn interest. You see, in this sitch, I'm paying this guy $15,000 a month or a year. Nothing to write home to mom about, but it's still new money that comes in every month. So that's another thought. And we can go over this on another video in more depth. Just the seller financing, the psychology behind it, the negotiation tax. We'll go on that in another video. So, and then in the third route, and this is what I said, like I said, I've done this on 3 of my 14 warehouses now. And this is what I like to do, and it's called a real estate syndication. It sounds like a big fancy word. It's really not that special. Essentially, it just means a bunch of investors are pooling their money together to buy an asset. That's what syndication very simply means. And there's a bunch of different models. You can Google it. You can get on, Investopedia, all these different sites, and learn about syndication. You got different waterfall models and all that kind of stuff. I went to public school, and I need simplistic ways of doing things. Maybe you're like me. I don't like to make things complicated. I like to be very simple and straight to the point. So let me give you an example on how, in a deal that I purchased back in February with a great friend, Digger Earls, down in Lafayette, Louisiana. He's a great friend of mine. We bought this building just recently. It's actually about 400 yards down the street from another 28,000 square foot warehouse that I own. That was with no money down. But this is the way that we did this. This seller, very simply, inherited this property from her father who passed away. She wasn't in real estate. She didn't even live in the same state. So she was more or less maybe a little emotional about owning it still, but really she just wanted to get out. She did not want to own property. She was not a real estate investor like her father was. So she just wanted to get out. She didn't want to leave money in the deal, right? She just wanted to move forward. So what I did and how I offer all of my partners is this, very simply. We go to the deal. Let's use this $1 million example. So again, purchase price of $1 million. What I'll do is, because the seller doesn't leave money in the deal, we're going to have to inject about $250,000 or 25% of the purchase price. So our loan is $750. Our down payment is $250. So where does that money come from, right? Usually in a syndication, it's split between two parties, a general partner and a limited partner. The general partner is the sponsor of the deal. They're the one finding the deal. They're the one finding the funding. They're the one managing the property. If there's an exit, they're the one in charge of the exit, all that stuff. The limited partner, on the other hand, is the individual or the individuals that bring the capital. And they're the ones that are injecting equity in order to close on the property, right? So this is what Digger and I did. Instead of me showing up with the $250, Digger brought that money to the closing, and he's the one that injected all the equity. The equity split or the ownership split is 50-50. I own 50% of this building, and Digger owns 50% of this building. The kicker is, though, and this is what I love about this because it creates opportunity of continuation, basically,
is I give Digger 100% of the cash flow. So after on this one deal, I think our cash flow is like, I mean, without getting on the weeds of that's one deal, call it $50,000 a year, right? $50K a year of cash flow. I'm willing to give Digger 100% of that money in order for him to get his money back faster, because then once this goes, after he gets all his 250 back, is whole again, that's when this cash flow begins to split 50-50. So how does this benefit me as the general partner? Well, number one, like I mentioned a second ago, with tax benefits, bonus depreciation is amazing. It's incredibly valuable if you own another business. Again, I'm in the life insurance and mentorship business as well. And we have other income that we're trying to find ways to offset and lower that tax exposure. So I'm willing to give up the cash flow now in order to get the larger tax benefit now, right? But in 5 or 6 years, once Digger makes his money back, and plus the rents will increase 3% every single year on this lease, I'm going to be able to split a larger number than what I otherwise would have done, like an 8% preferred return with a pref on the back end, or like, the way the waterfall model is. And that's just not for me. So I'd much rather have much larger ownership. And then plus, whenever we exit sometime in the future, well then, I'm going to get a larger slice of that on the back end, the capital gain. So what I've discovered is those are the three main ways that I've discovered to purchase real estate. You can inject your own equity into deals. You can have the seller leave money in the deal by financing you the down payment. And third, syndicating, pooling assets together or money from other investors, using that as the down payment, and then syndicating property. That way you, as the general partner or the sponsor, can be in deals for very little of your own money, especially if you are working with other people that have a lot or a little they want to invest. And my final thought before we get into some of these questions is, you'd be shocked. Do not, my parents are in their 60s, they're close to having their house paid off, or maybe it might be paid off, I'm not sure. But they have a lot of equity in their home. They have a lot of ownership in it. And a lot of these individuals, especially the baby boomers that probably have some money, they're looking for these opportunities. They are looking for real estate opportunities, but don't ask people to invest in your project. Offer them the opportunity to invest in your project. You have to switch your mindset from asking and having hesitation and fear of rejection. Instead, think about you have an amazing opportunity for them and you're making them an offer. So change how you think about that. Okay, Zane, I don't know how much time we got, maybe 10 minutes if you want to jump into it real quick. Ask a couple questions.
Yeah, so Mr. Opinionated asks, for seller financing, is it better for the seller to own the property outright or if they have existing debt on the property?
If they own the property outright, ask that one more time, I'm sorry.
So if the seller owns the property outright, is it better to offer seller financing in that case, or if they have existing debt on it?
It doesn't. So the question is if the seller owns the building outright, or if he has debt on it, does it affect the seller possession mortgage? It absolutely does not affect it. So let's say that $1 million warehouse. If the seller has $500,000 of debt, what's going to happen is me coming in to purchase, I'm going to replace that old mortgage with a new mortgage, right, from my bank. Or if you're like I was listening at the beginning of the video, you've already called that same bank that holds the debt right now in order to get maybe more favorable terms on that piece of property. So it doesn't affect at all if there's a mortgage on it or not. The only difference is going to be at closing is how much that guy's going to walk away with. Now, if he has the building really paid down, he's going to get a much larger chunk because the bank is going to write that much larger loan-to-value check. But most importantly, the key is talking to the seller first and figuring out what their pain points are, what's going to happen with their tax implications and how much they're going to have to pay, and then making them an offer that reduces that exposure in order to make more money and keep more money in their pocket. So if that answers your question.
Okay. All right, Gil asks, in the event of seller financing, does the seller retain depreciation or have to recapture? Are you retaining 100% of it?
Yeah, so in seller financing, that the previous owner is deeding the property to you. You are now the 100% owner of this property. The seller is no longer. What happens is, like you notice, like I said before, in this HUD statement, on a HUD statement, you have a first mortgage and a second mortgage. And a mortgage is a claim to something. It's a lien. It's not ownership. It's a claim. So the bank, remember, the banks are not in the real estate ownership business. They're in the lending business. So they're not trying to own property. This guy that sold this to you is then subordinating his position behind the bank. The bank just has a claim to your property. That's all it is, but they don't own it the way you do. So the seller, in this case, if they took any depreciation, and you'd probably be shocked about this, a lot of them don't even know much about bonus depreciation. So they've probably been taking either straight line or haven't been taking depreciation at all. So there might not be some recapture. But if there is recapture, and very simply, bonus or depreciation recapture just means if you've taken deductions for the lifetime of the ownership of the property, you have to recapture that loss, that passive loss, and it goes towards, again, you got to pay that back essentially on paper. There's a couple of solutions on that. I've made some other videos on it, but the guy can definitely go buy something else. He can 1031 into something else if he wanted to. But my accountant, CPA certified, would say always take the deduction because it's so much more valuable now to take the deduction than it would be to not take the deduction and then have to pay the recapture. The tax is always much smaller than the benefits of bonus depreciation or depreciation in general. So if he would sell it to me, yes, he would have to recapture the depreciation. But you as the purchaser, if you can provide a solution to that via, showing how leaving money in the deal can save him taxes, it's going to benefit both parties.
Okay, Michael Clay asks, what is your main exit strategy when both seller financing and syndicating?
What's my main exit strategy on these deals? So very simply, I had a mentor tell me once that the name of the game in real estate to get rich is to double the value of your property in 12 months or less, right? So every deal that I go into is not so much based on what is the existing cash flow, right? Like a building, for example, like I showed you that single family house in the beginning, there's nothing really I can do to that house to make it to double the value. I can't turn a $100,000 house into a $200,000 house in 1 year. It's not going to happen because residential property is valued based upon the comparable sales and what's around it. Commercial real estate, on the other hand, what's so powerful and why I love it so much more is because it rewards your creativity. Meaning, what I'm doing now, when I go buy a piece of property, I'm not only looking at the size of the property, but I'm also looking at who could benefit from this, number one, but also what's around it. Are there adjacent parcels, maybe some laydown yard or opportunities I can maybe purchase or generate a ground lease and increase the rental income? Because in commercial real estate, if you increase the rental income, you increase the value, which is the opposite of residential property. So my whole thought is how can I turn what was before only generating $100,000 of net operating income? How can I turn it into generating $200,000 of net operating income? And that's either by, maybe splicing a larger building up into smaller bays that you can generate a higher price per foot, or again, maybe purchasing an adjacent parcel to create some laydown yard which opens up more tenant pool for you to lease to, maybe a longer lease or somewhere where you buy it at even a higher cap rate, improve the site, and then sell it at a lower cap rate. But the name of the game is when you exit something, always finding ways to double the value. And then, of course, like anybody would say, you can always 1031 into the next deal, or you can Google the strategy that Robert Kiyosaki and Tom Wheelwright came up with. It's buy, borrow, and die. You buy something, you borrow money to buy it, and then when you pass away, you get what's called a step up in basis. Your kids get to have it, and they don't pay income tax on it or estate taxes. All right, everybody, thanks so much for making it. We can't wait to see you on the next video, and a Happy New Year. See you then. Thanks.